Hello, welcome to It's Your Smarter Money with Dr. Laura and Professor Steve, continuing to talk about bonds. And this series is really an entire grouping of different videos and different blogs where we're talking about bonds. And our hope is if you watch all of these individual videos and read our blogs, that you'll have a much better understanding of why bonds have a role in your portfolio. So in this particular video, what we want to talk about is some of the more traditional bonds that most people might consider for their portfolio. And so we break up the two types of bonds, the two types of traditional bonds, into those which are non-taxable and those which are taxable.
Yeah, and I want to mention that there's many ways that you could actually break bonds down. We sort of felt that this was a good way to break them down because of its effect on, well, how your portfolio is taxed. We just thought that was a major dividing line between types of bonds. By the way, Laura, we're going to do as many videos as there are James bonds.
We might do as many, for sure.
That's like 9, right, or something, I think.
I'm
sorry.
Oh, yes. So yes, we're talking about bonds, not James Bond, but you always like to think of James Bond when we're talking about him because it makes it fun. But one of the reasons why I guess we feel that it's important to break this up is, as comprehensive financial advisors, as fiduciaries, we need to consider all the aspects of the investment choices. And one of the big aspects of bonds is that they are taxed differently than stocks.
They are.
You mentioned that last time, and it's important to know that when you receive income from the interest that's paying you throughout the course of time, it's going to be taxed, and it's not going to be taxed as capital gains. It's going to be taxed as ordinary income.
Ordinary income. With right now the highest bracket for ordinary income is about 37%, but there's some talk of raising it back up to 39.6. And by the way, the types of bonds, taxable and non-taxable, there's a couple of key drivers with respect to which ones we would recommend for a client. First of all is your marginal tax bracket. Probably if you're 15 or 18% and over, depending upon the difference in the yield curves of taxable versus non, we may recommend non-taxable. And additionally is also where the bonds are going to be held. So for example, the bulk of your investments are in tax deferred accounts. Of course, we'd be using taxable bonds.
And we spend a lot of time, once we do the asset allocation, determining the asset location and how we want to structure, is it worth it to get non-taxable bonds to put in your in your taxable account, or vice versa. So there's a lot of analysis that needs to go into that because, of course, taxes don't necessarily wag the proverbial investment dog, but they are something that really should be considered when you're investing.
Yeah, so it's also, from our view, is value added for you as the client if we're careful with how much you're being taxed and what your tax liability is each year. And so if we can affect that by making your portfolio more tax efficient, we'll try to do our best to do that.
So within the non-taxable camp, we actually want to spend more time talking about municipals. We're going to do a whole video just on municipals. Yep. But it's important to understand what these are in the non-taxable camp. I mean, generally, they are issues from the government. They're not a corporate entity, they're the government. And the reason why they make them non-taxable is they're trying to encourage people to invest in their overall organization. So the federal government issues out non-taxable types of bonds, and so do municipalities, the states, the cities, and other government types of agencies will issue out these non-taxable bonds.
So for years, the federal government has allowed municipalities to issue bonds that are non-taxable, and because they want to lower the cost of financing projects on a municipal level. And so they can issue these bonds with a lower rate of interest because they're non-taxable, which costs towns and cities less money than if they had to issue taxable bonds. And by the way, I want to mention that generally tax-frees are issued by states and towns and cities, not so much by the federal government. The federal government issues treasuries, which are only partially non-taxable. They're non-taxable on a state level, but they're taxable on the federal level.
And for municipalities, it depends. It's not usually taxable to the federal government,
Yep.
but it depends what state you actually wind up investing in. And you know, that's something else to talk about. All of these non-taxable investments should be noticed that because you're getting that benefit of not having to pay taxes, you usually will receive a lower yield.
There's actually a calculation we do to look at what the pre-tax yield in effect would be on a municipal. Okay? And we'll probably be covering that in another video. And then of course you have taxable bonds, and they're issued by a number of different types of entities. You have corporate bonds issued by corporations, bank CDs. You know, there are also taxable municipal bonds, by the way. A lot of people aren't aware of that. And a lot of times they can make a lot of sense to be held in an IRA. And it's also government agencies like Fannie Mae and Freddie Mac. Freddie Mac, for example, Freddie Mac, our Federal National Mortgage Association is the one I meant. They actually issue bonds because what they do is they will actually buy mortgages from banks, and they'll raise the money to buy these mortgages from banks by selling bonds. And the reason they do that is because they want to provide liquidity into the mortgage market and actually make more cash available for banks to lend to homeowners, those who are purchasing homes.
And so you see that there's a mixture again of government types of organizations and private organizations like corporations, yeah, that are not part of the government system. And your choice of which one you're going to invest might have something to do with whether you want to be taxed or not. It also might have something to do with whether you want some kind of government backing. Generally, the government agencies aren't exactly fully backed, but they have an implied backing.
That's correct.
And so, you know, that's one of the reasons why somebody might want to invest in them. Bank CDs, people like them oftentimes because they are backed by FDIC insurance up to $250,000. And so sometimes people would like to invest in CDs. CDs are interesting because you can get CDs from a bank that you're locked in for a period of time. Usually most CDs have a time horizon anywhere between a month and I think 10 years. Most people will usually stay shorter on that curve, but of course the interest payout will be more if you're in for a longer duration. The problem is if you go for a longer duration and you get one of the CDs that have a penalty associated with it, it could really cost you. Some of the penalties that we've heard is up to 6 months of interest rate that you could be docked for having taken your money out.
Well, Laura and I were just joking that they would take your toaster back as well.
And all of you know that Steve and I don't like anything that you're locked into. Generally, we want to know that anything you're invested in, if you want to take all your money and escape to Tahiti, that it might take a couple days to settle, but you can do that. And so we would always try to encourage you to go for CDs that don't have a penalty associated with that. And so for our clients, that's what we use, our penalty-free CDs that can be traded on the secondary market.
And at some point in another video, perhaps we'll rank these bonds by level of safety. And some of it is safety that's inherent because of a guarantee by the entity or some third party. And so in the case of treasuries, obviously, they're considered to be riskless. That's generally the feeling about them. Municipals have had a very low default rate historically, but you know, CDs also very low risk because of that FDIC insurance. Taxable munis as well. But then when you start to get into corporates, you start to get into the possibility of default, and much more than you'll see typically with municipals, especially as when you go to the lower quality rated corporates, there is significant risk of default there.
Right, and that's something that we want to talk about in another discussion in terms of the alternative types of bonds that people go into, which people call high yield or junk bonds. But even just staying on the corporate bond arena, corporate bonds have a much higher default rate than municipal bonds. Corporate bonds are much more correlated with the US equity than a sovereign debt or a government debt. And just think about it. They're being issued by the same organization that's issuing stock. So if you're getting a bond from a corporation where you also have stock of that corporation, you're going to be impacted by things that are happening at that corporation. Whereas if you have just a government bond, that actually has a different pattern of behavior. And we saw government types of bonds, sovereign debt, do very, very well in some of the worst markets. You know, when we look back at, for example, 2008, I think sovereign debt, people said everything went down. The sovereign debt didn't go down.
It did. Part of that, see, there's this flight to safety phenomena. What happens? We saw that again in 2020 at the beginning of COVID. People leave the stock market, they leave other types of risky assets and try to go into the safest assets. And typically those are government bonds, especially treasuries, and as Laura mentioned, sovereign debt. And so it's that flight to safety which props up the price of those bonds and keeps them from their value from dropping like a corporate bond's value will drop.
So assuming that you have bought into the fact that you would like to have fixed income in your portfolio, you understand the benefits of fixed income, which we talked about in our first video on bonds, and you then need to determine what kinds of bonds you want to choose. The first place to look is in the traditional bond grouping, and you're going to look at the aspects of taxes that might impact you. You're going to look at what kind of insurance you want. You're going to look at how much diversification you want, and that's going to help you make a decision on the type of bond that you want to have in your portfolio.
Exactly.
So,
go ahead, Laura. I guess what I was just going to say, what we're going to do is we like to have a summary at the end of these videos just to show you what the path is going forward in terms of what we're going to be covering. Laura, go ahead.
Well, I was just going to jump the gun and say, we talked about the initial what bonds are and why they should be in your portfolio. Right now, we just talked about the traditional bonds, but there are other bonds too that we want to talk about. We want to talk about, we want to go deeper into municipals because those are very, very interesting for a lot of people. And then, some of the other alternatives that people probably have no business investing in, and maybe even some other alternatives that are tremendous opportunities as well, such as convertible bonds, even international bonds that we use. And then there's a bunch of other, what are the risks associated with these bonds? What kinds of, other advanced topics we might get a little bit more into the duration and maturity and how we
call features also, for example, and what happens when a bond is downgraded and the difference in the yield curves. There's a lot to talk about.
Right. So if you have a specific item that you would like us to include in this series, please give us a call or email us and let us know what you'd like us to include, because at the end of this series, our hope is that you're going to be well-versed, you're going to understand why bonds are in your portfolio, and you're going to be so much more confident and secure in your financial future. So thank you for listening.